On the topic of credit spreads, Robert says, I have a plan to manage or close out my credit spreads when the stock's within 1% of my short strike. That's typically what we do as well. What if that trigger happens in the first 3 days of the positions? Do I still close out or wait and see? You probably want to close out because you're probably at that 50% loss, Robert, and you don't want to let it go to a higher loss. I've done that in the past and suffered max loss because the stock never recovered. That is the key. And I hate to beat a dead horse here, for lack of a better term. Let's go back. 85% probability. Why am I so focused on this 50% return with what we've been talking about here with that bull put credit spread approach? Yeah, that's too much. 88 is too much. 84, okay, we'll leave it there. You saw what happened at 85, Robert. You saw what we were looking at. You saw what happened when we cut the profit in half. What happens if I keep an 85% success rate? Don't close the positions early on my bull puts, keep the 15% return. Still have an 85% success rate, but I hold on, as you mentioned, and allow those losses to go beyond 75%. I'm almost bankrupt at an 83% success rate. Okay, manage if I get 88%, looking really good. 84%. We took $10,000 down to about $2,400. That's not good. I want to get to 85. It's bankrupt after 57. There we go. With keeping the loss ratio to 50%. If the stock hits that 1% stop. Now, I don't know if you're doing 5-day out trades, Robert, if you're doing 14-day out trades in those scenarios. But again, not controlling the losses, it is what kills your portfolio. Hanging on and hoping is what's killing the portfolio with the spread positions. You have to control the losses regardless of what position you're doing. You have to try to control it to that 50% loss. In those cases, yeah, 90% way too high. There we go. So that you can stay successful and control the drawdowns. The lie of leverage works both ways. Now, what would happen if in 3 days, let's just take a general search. We're going to stick within the NVIDIA. This is my weekly bull put. So we're still on that 85% probability, Robert. And using the power options tools, let's go to the profit and loss chart. Okay. I'm expecting a max return of 17.4%, 37 cents at midpoint roughly, with a risk of 213. Yeah, it's a 250 spread, but Robert, but again, I keep the 37 cents regardless of what happens. So my true risk is only going to be 213. What have I sold? The 300. So what happens if the stock hits 303 on Wednesday of next week, right before Thanksgiving? Major bummer, of course. Tuesday. So on 11/24, what would I expect in that case? This is theoretical. This is not real world. The volatility might change in this case. It might be popping up to 0.52 or 0.56, and these prices must be different. But remember, 213 is the maximum loss. 50% of that, what am I talking about here? 107, 106, liquidation value. Theoretically, even if the stock hits the 1% rule in the first 3 days, I might only be able to get out of this with a $70 loss. Yeah, my short put's going to go up drastically, but my long put's going to increase also as well with the current volatilities and expectation in 3 days. Okay, so I could still get out with less than 50% loss, which would be in this case, okay, 106.50. I could get out with 70. Now, again, that's theoretical based on the current implied volatility, Robert, and so forth. What if it happens that it drops to 303 closer to expiration on 12/1? Now it's actually less because we're getting more time value decay in our favor. So this is why I feel that it's important. Going back to 11/24, going back to Wednesday, this is not 50% of the maximum loss. The maximum loss, again, the 50% of the maximum would have been 106.50 or 106. Here we're at 70. Okay, could I hold on for an extra day or two? Maybe, but what do I don't want to necessarily let happen? As you know, Robert, in any naked put position, if I sell a 300 put, I have an obligation to buy X amount of shares at 300. If NVIDIA falls below that, I can be assigned at any time. Being in a spread does not change that obligation. I'm in this bull put spread and the stock drops down to 298. It hasn't hit my strike price yet of 297.50. If I get assigned early, if I did 10 contracts, I'm going to be forced to buy 1,000 shares of NVIDIA at $300 per share. My broker can't exercise this lower strike put. Legally, they can't exercise that put to buy stock at a lower price than the market is offering at 298. They can't exercise the 297.50. So I'm on the hook for that. Now, my broker, of course, may cover that for me, close it out at market price, so I still take a loss. It's not the maximum loss, but it's close to it. But again, then I'm going to get charged penalties and possibly a margin fee by my broker because I didn't have the full amount. But that's still an obligation that you do have to cover the position in that case. The spread covers it. And if it drops below both strike prices, you hit the maximum losses, Robert. But normally, if you're in the 1% rule, you'll be around that 50% stop. You can use the field here to run your what if scenarios to see what would happen if I was within 1%, 1 day away, 2 days away, 3 days away. I probably ad nauseum to all of you, but I hope I've illustrated enough the importance on these leveraged spread trades of not letting it go past a 50% stop if you can control it. We all saw what most of us probably saw what Mara did the other day. I did have a gentleman who's in a naked put, not in a bull put credit spread. When Mara dropped from about $68 down to 52 or 53, I don't know where it ended up at the end of the week. But again, that was a 54.68. Well, it went up a little bit today. But earlier this week on Mara, there it is, that declined. Oh, it was up at 75. He was in at about 68, I think, and it had the drop down to 55, continued down below 50 during the week, and then came back up slightly in that case. Where am I going with this? Well, I bet you that if I had opened a Mara position with an 85% probability on a bull put spread at this time, with the stock being up here, I probably would have been at 62.5, 60 to 55. This drop would have dropped it below both strike prices. I'm near 70, 80% loss. I can't control that one. But on these other positions where we see these kind of declines, when it hits it at the 1% stop, Robert, you want to make sure you don't let it go past the 50% loss in the trade simulator tool as illustrated for us. Okay. Pavol. Okay, Pavol asked a great question here, and it was similar to the question he asked before that maybe I didn't answer as well as I should have. Your previous comment, Pavol, I understand. But Pavol says this 50% stop that you keep referring to, this 50% stop on the spread. Where's NVIDIA? There we go. Oh, sorry, profit loss chart. 50% of that. Is that the sweet spot between controlling the losses and getting stopped out too often? And my answer, yes. With this criteria, with what we've put together for you, the testing that we did, if I allowed 60 to 65% losses, we already saw what would happen. If I tried to control the losses on the bull put credit spread, Pavol, in this structure with the criteria I used, the testing, and actual trading that we've done since about end of 2015, I'd say, you don't get the win ratio you want. You're not at 80, 85%. You're like at 72, 73. You're closing positions out too often if you set that stop too low, and that was the problem. So for this structure, that's what I found. But hey, test it out on your own. Pavol, go to radioactivetrading.com. Jump into the resources tab. Jump into the trade simulator tool. Try it out. You expect 15% return. You expect an 85% probability, or maybe you're looking for that 30% return with a 70% probability or 30% probability of loss, and control your losses to 35%. Unfortunately, as I mentioned earlier for James of what criteria she to put in, that wouldn't be realistic. This is not a realistic number. 30% expected return on a 70% probability spread and being able to control losses consistently to 35%. That's going to be closer to 67%. It's impossible to do. And in real world trading, although these numbers look great in real world trading, you're going to find yourself closing those positions out way, way too often. Robert, sub-related question. I'm sorry. You said, is it good practice not to open a credit spread at all if the stock is already within 10% of the short strike? No, I can't answer that. That's your preference. Okay, what makes you comfortable, Robert? That's what you want to do. I can set up the screen specifically on bull puts to look for percent out of the money greater than 10% or more, if that's my preference. In general, my ranges are usually about, and I'm going 14 days out in time. Some of these are 10s, but my average range, I'd say, is about 7. And the average is usually what is. Come Monday, when I look at this search, the average range out of the money for the positions that are 11 days away is probably going to be around 7 or 8%, because it matches the other criteria I want. If I look for a higher probability of 90%, then I'd know I'd be looking for lower return, and I could force that Robert to be 10% out of the money. But I'm not. What can I do? Okay. What can I do is say, all right, I want the positions that have a higher return of 25% or more. So I know I have to lower my probability, but at the same time, I want to be 10% out of the money for a 1 week out or a 2 week out trade. If they're there, this tool is going to find them. Ooh, these two positions, look at this implied volatility in Lucid, 1.3%. This thing fluctuates wildly. I don't think it's worth it, even though you're 15% out of the money on the position. You're selling a 47 strike against a $55 stock with a 34.7% return, 75% probability. A lot of danger in Lucid. These are the more volatile positions, and I wouldn't advise it. Now, that being said, if you're a bit of a gambler, if you want to find positions that have a 25% return, 10% out of the money, 1 or 2 weeks out in time, and have maybe an 80 or 78% probability, this is the tool that's going to find them, Robert. You know that. This tool will find them if they're there. But most of those ones you're going to see are going to be in this extremely risky implied volatility range on volatile stocks like Mara that we just showed a little while ago, with that drop from 75 down below 50 over a 5-day period, and it's just come back up to 55 as well. Okay. All right, well, ladies and gentlemen, I want to remind everyone, of course, that today's material and my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as recommendations or direct trading suggestions. Options involve risk, as we saw, and may not be suitable for all investors. Now, we went through a lot of tools today. I know we went through a lot of information. We showed the search tool. We showed some of the historical capabilities in the beginning for Kenneth. We looked at the profit and loss charts and evaluating what-if scenarios. We spent a lot of time on that trade simulator tool, theoretical discussion on what to expect in given strategies. But remember, you can take a 14-day free trial at any time. Just go to powerup.com, put in your name and email address, and you have full use of those tools, plus our signature tools, 2 months, 3 months actually, of back testing capability, the portfolio tools, and more. No credit card required. After that, the subscription level started only $45 per month for the end of day data. The delayed data service, where the data is updated every 12 to 15 minutes, is only $65 per month. We do, of course, offer real-time service and access to the historical as well. We didn't go through much of the webinars today. We did mention, you can check us out on YouTube there. When you go to YouTube, you can find our videos and then just use the search function on our site to find videos on, say, credit spreads, debit spreads. Then you might want to be able to go to YouTube and look at the money debit spreads or out of the money debit spreads. Just more information on what we sort of discussed there. And of course, you can go to the webinars page at any time on the Power Options account, powerup.com/webinars.asp. Subscribers have full access to all of those presentations, but trial members have access, and it is a public page, so public members can access many of the videos. Well, I would not say most, but trial members have access to most, and subscribers have access to all. If you do think of any other questions, of course, send us an email at any time to support@powerup.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Trial members and subscribers, you can schedule a coaching session at any time. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have. A lot like today, but more of a one-on-one session. You can request to have a go-to-meeting/go-to-webinar Teams meeting for your coaching session as well if you want to see our screen. Normally, we just do it over the phone, but we can do that as well. Thank you, everyone. Have a fantastic weekend. Happy Thanksgiving. I'll see you in 2 weeks. Take care, everyone. Good night.